Much ado about nothing. Crude oil, a little changed on the day, but it has been swinging quite a bit since overnight news of the OPEC cut confirmed what we first heard from the president a couple weeks back. Let's bring in Scott Bauer. He's the CEO of Prosper Trading Academy. So, Scott, this saga started around 22 bucks when the president's first tweet hit that this thing was coming. There was a lot of doubt that it was going to happen, questioning about when and if, and now suddenly we're like right back to where we were before this whole thing at $22.70.
You know, I feel like we had this conversation about a week ago, Oliver, when the news first came out before Russia and OPEC, put their meeting off. We had this same conversation on the big rally up in oil and what to do. And, I had an uber bearish spread on when that news came out to fade that news. And you know what, Oliver? It's the same thing right now, because what the world is finding out right now, this is not a supply issue right now. It is 100%, or let's put it 90%, a demand issue. When we got hit with both the supply and demand a month ago or so when this all happened, that was one thing. Now the world is finding out it is completely a demand issue. And until we are on the other side of the virus, and until, the economies and commerce starts getting back to some semblance of normal here, it will continue to be a demand issue.
So, Scott, this is where the questions arise, right? Which is, it's hard to gauge just how much the hit is going to be, but we look outside and we see nobody driving. We know that Caterpillar today in the Bank of America downgrade saying steer clear anything that has to do with energy and overall demand for that market. So give me the trade here. I mean, you still want to do uber bearish, or did the drop in the price maybe take some potential there off the table?
I am still very uber bearish for the short run here. And let me make that case. This is for the short run, but it's all risk defined. So, looking at options and crude futures here, I'm looking at like what we did a couple weeks ago when we were together, Oliver. I'm selling a call spread to finance the purchase of my put spread. Okay, so it's basically a zero cost transaction, a zero cost trade here. So I'm looking to sell the 24-26 call spread to pay for buying my 21-19 put spread. If oil rallies here, okay, I know what my risk is to the upside. I got it. But man, oh man, I just don't see how things are going to change here in the near future. There is a very, very steep futures curve going out 3 months, 6 months, 9 months, but I'm looking at a very short-term trade.
So what's important here is that even though you're selling some options, each leg is balanced both with selling and buying. So you've got spreads on both ends. So your P&L, your risk profile for this is going to be pretty far skewed, but still capped at both ends.
Correct. $2 to the upside, $2 to the downside. So if oil goes up, my shorts are the 24 calls. I'm stopped out by my 26, so it can go to $2 there. On the downside, I own the 21 put. I've sold the 19 put, so that can go to $2 as there as well.
All right, Scott Bauer, appreciate the trade here. CEO of Prosper Trading Academy, uber bearish. That's not mine, that's Scott Bauer's terminology. All right, there's conviction when you hear phrasing like that.